All right, let me get started so we can start on time, end on time. We keep these to a nice quick 30 minutes. They are our quarterly market update. I'm Andrew Rosen, President Diversified. Mike Horwath is our Chief Investment Officer, who's in charge of all of our investments. And we like to do these as a nice give back and education forum for our clients where they can hear directly from the horse's mouth what's going on, what he sees, what he anticipates. And feel free, this is you can ask questions by just typing in the chat box. I'll do my best to get to any, but I'm going to turn it over to the one and only Mike Horwath. Mike, take us away, educate us, please.
Thank you, Andrew. Thank you, everybody, for hopping on. As Andrew said, my name is Mike Horwath. For those of you who have not joined us before on one of these, this is our normal quarterly cadence where we walk through really just on a top high level of what's happening, and then we try to dig into the main topics of markets, the economy, what's going on, what's good, what's bad, things like that. So I try to keep it 20-25 minutes and then leave a few for Q&A. Hopefully I do an okay job with that today. But why don't we just jump on in, because there's a lot going on that we want to cover and kind of talk through. So let's do that. So first, my newsletter's coming out here in a couple of days, and I titled it "Patience is a Virtue," right? And I just think it's timely that we reconvene on remembering our long-term patient approach to investing and being opportunistic, but not getting too high, not getting too low when it comes to investments. Because what we saw last year into this year, the ups and downs this year, most recently kind of pulling back, it naturally just creates a whirlwind of behavior, of emotion. So be patient, rely on us, rely on your team here to kind of get you through it and walk through what's going on. But from an economic and market perspective, we've seen a shift this year. We've shifted from inflation and interest rates, where interest rates are a concern, but inflation is no longer the biggest concern. All of a sudden now it's interest rates and economic growth, right? What happens to growth? Because if you think about the economic cycle, the classic cycle is that, as the markets recover, GDP picks up. A lot of times inflation picks up, the Fed raises rates to slow the economy, it goes into a slowdown, then they cut rates again to try to simulate it, and you kind of do this circle. So as they've raised rates, the natural concern is what happens to economic growth? And I'll kind of talk you through the chart on the right here in a moment. But inflation, while it's still above target, right, and it's decently above target, depending on what measure you look at, we are clearly in a disinflation environment, right? Inflation is coming down. Right, and we're starting to see it, in the threes. At times it was in the twos, right? A two handles, what they call it, 2.8, 2.9, maybe three, the low threes. That's much better than what we saw middle of last year, early last year. The Fed has clearly been the main driver of volatility, of conversation. They've hiked rates from zero, right? They always quote interest rates in a range. It was 0 to 25 basis points, so 0.25%. We are now at 5.25 to 5.5. We've grown quickly and pretty sizably over the last 18 months. The question now, and this is something that we'll talk about in a second in a little fancy chart, will they raise again? Are they done? And when do they start cutting? And this is the dynamic that the market is really struggling to get a grip on. Because really, up until about a month ago, maybe a month and a half, markets have really been more constructive on the Fed is officially done and they're going to cut several times next year. Well, the Fed came out and they said, slow down. We're not quite there yet. And markets have kind of been repricing themselves. And it's not a surprise to us that they said that. And we can talk about that here in a second. Good part is corporate fundamentals look good. We'll talk about that pretty extensively. And market returns have kind of responded pretty well, right? As inflation's come down, corporate fundamentals look good. Unemployment's really strong. Markets have done well. right? It's been, especially on the equity side. And they've come back a little bit more recently, but by and large, it's been a bounce back year off of 2022. And part of that's also, we talk about unemployment and the consumer and all these little things. And all that stems through to corporate profits and profit margins being strong. On the right-hand side, I think this has been the story. So on the right-hand side, you see GDP measured in two different ways, right? The gray line is 2023. So that's the measure or the estimate for 2023 total GDP growth. And the blue line is the estimate for 2024. And what you're seeing is as the year has progressed, markets have been pricing in and believing that 2023 economic growth is going to be better than expected. And we've seen that in the data. What the expectation now is becoming is that some of the economic slowdown is just being pushed off into 2024. But you'll see economic growth is still pretty strong. It's just there's a shifting dynamic of potential slowdown for Q3, Q4 this year over to Q1, Q2 of 24. So that's important to think about. What changed, right? What happened in the last month and a half? This fancy looking, confusing chart is really what happened, right? This is what they call the Fed's dot plot. This is where those Fed voting members and participants list what their expected interest rate is. They all do it independently over each calendar year. In the red box, really what I've highlighted and what's important to know is that in that first column, right, in 2023, you can see that the Fed individuals don't believe that they're officially done yet. At least several don't. Really, what that shows is they expect maybe another 25 basis points, 0.25% this year. And the big thing is in 2024, what they had originally been showing or what people were pricing in was that we'd have 4, potentially up to 6 rate cuts during that year. Well, what you see is there is a conglomerate of voting members and members of the Fed who either don't believe that rates are getting cut really at all next year, or there's only 1, 2, maybe 3 cuts next year, right? So the expected interest rate path has changed a little bit, and you keep hearing the term higher for longer. And it's something that we've really believed that was going to be the case for several months. I think the market is kind of catching up to that. And part of it is, and we'll talk about it in a second, there's just not much of a reason yet for the Fed to cut rates. And there's also just historical concerns around if you start cutting too early and claiming that you beat inflation too early, historically, those are the times where inflation comes back, right? They do not want that to happen. They want it to be gone, and then they'll begin to cut. So what's happened from an asset class perspective? I highlight the major asset classes from equity and fixed income. So you can see with rates rising towards the bottom, you'll see the fixed income world has just had a rough year again this year. And I think there's optimism moving forward. We're still very optimistic for the bond part of your portfolios, but so far this year, down about 1%. On the equity side, we actually had seen equity markets rally into the mid-teens and certain parts of the market, right? The tech side, the growth side, especially on the US side, up in the high 20s and low 30s for the year. That has since pulled back. You're seeing global markets on the equity side about 10%. Through yesterday, you're more in the high single digits as they pull back a little bit this month. But by and large, coming off of 2022, we've seen equity markets bounce back pretty reasonably well. Maybe not so much as recently, but you are seeing bond markets still having to deal with higher and higher bond yields or higher rate expectations. The good part is if you look today moving forward, the bond market is in a much better place than it was just 18 months, if not 2 years ago at this point. So where are we at on inflation? I mentioned it earlier. We are officially in more of a deflation or disinflationary environment, right? Where the rate of inflation is just coming down slowly. The left-hand side is clearly, though, a different conversation than the right-hand side. So on the left-hand side, that's headline inflation. So headline measures really everything. That's their basket of everything, which includes energy and food. A little more volatile, but you've seen, especially with energy prices, although they've kind of ticked back up more recently, you've seen headline inflation ease. The core side remains the problem, right? The core side, you've seen it kind of peak and plateau, both here in the US, which actually has come down a little bit here in the US, but especially internationally, this part of the inflation conversation has really plateaued. So this is the area where you really need to see the disinflationary environment pick up to get back down to target. One of the major areas, we've discussed it ad nauseum, is really the housing market, right? The housing market, both housing prices and rents, and the way in which they are calculated into the inflation conversation, are very important, right? And we need to see those roll over. The good part is if you look at all the measures about rent prices and equivalent rents, that inflationary conversation has certainly eased, and that will start to get factored into the inflation and CPI measures on a forward-looking basis. So we expect inflation to keep easing. The question is, does it get down to target? Is there a potential for it to pick back up? That's what the Fed wants to avoid. And this is what the market's projecting here, right? So there's two main measures. One, it's what does the market think is going to happen on a forward-looking basis for inflation? That's the blue line. So this is up until about a couple months ago, what actually happened as you saw this disinflationary environment. And then as you start to go from the middle of the chart to the right, once it gets to the blue dotted line on towards the right-hand side, that's what the market's pricing in. The market is comfortable with the inflation backdrop. The market is seeing and believes that inflation is coming down, which ties back to what the data is also telling you, right? This is what we should be expecting, is that inflation will continue to push down. What's important, though, is how does that relate to the purple line, which is what the market's pricing in for interest rates, right? Short-term rates from the Fed. And what you see is that there's been naturally this gradual, or maybe not so gradual, pickup in interest rates and short-term rates, and markets pricing in not much movement over the course of the next several months, right? Which aligns with what the Fed's telling people, right? Is that higher for longer is likely the scenario. They may be done. They're likely very close to being done, if not already done. I think a case can easily be made that they're done, right? They're just telling the market to not get ahead of themselves. But rate cuts are a different conversation. And the markets have had to come to an adjustment here of rates aren't going to get cut super quickly. But this has been the story, right? This is the Treasury yield curve for interest rates going back to 21, right? The end of 21, the end of 22, and then where we stand today. And what you can see is it's just been a constant evolution forward, right? From the end of 21 to the end of 22. We all know what happened in 22 from a market perspective, but that's really the story. It's been this big push up in both short-term rates, right? So you see the short-term end of the curve is higher than the long-term end. That's what's called an inverted yield curve. It's a tough environment for banks. It's an environment, though, where the Fed is restrictive and they're trying to slow either the economy. They're really in turn, they're trying to slow inflation as part of that, or as the major part of that, which in turn does tend to affect economic growth. But this is the story. Interest rates have continued to push up. We do, though, believe that we're at really the high end of where we're going to be. It doesn't mean that they couldn't go higher if something were to change, but investors should not believe that they are going to meaningfully go higher at this point. So then, Mike, when do rates fall? Right, and I use this graphic actually, I think during the last both newsletter and webinar. This is a great graphic to illustrate historically when the Fed started to cut rates. And you can see there's one of two scenarios that really need to happen. Either you need to be farther out to the right, which means unemployment picks up and they feel like they have to cut rates to kind of stimulate the economy and bring back unemployment, or you need to be in a scenario where you are farther down in this graphic, which means that inflation is really right around their target. So you can see, when they started cutting rates back in 2019, they did so when inflation was non-existent, right? Today, we are too far up on this curve and too far left on this curve or this graphic to really warrant them starting to cut rates. Unemployment is still extremely strong. Inflation's still above their target. Both of those will keep them at current levels of interest rates until either something breaks or something methodically moves into a position where inflation's down to their target or unemployment slowly starts to move up. We would expect inflation to come down quicker than we would expect unemployment to pick up, which is a good thing, right? That is a good scenario, right? Because the last thing you really do want is unemployment to really rise very quickly, and all of a sudden we're trying to cut rates to stimulate an economy and to get employers employing people again. But that is naturally the question when it comes to when do we cut interest rates on a forward-looking basis. Equities, if we kind of dive into what's worked and what hasn't worked, U.S. large cap growth has held its dominance throughout this year. The primary theme for 23 has been there are just a couple of equities that continue to drive returns. There's a couple reasons for it. Probably the biggest being is this kind of this surge in AI conversation, right? Artificial intelligence and who's going to benefit from it. So after 2022, where we saw tech stocks and high growth stocks kind of pull back pretty meaningfully, well, 23 has been kind of this reversion where they've kind of taken off, and companies like NVIDIA, right? NVIDIA's been one of the biggest benefactors of AI because of their exposure to that market and their business model and how it relates to the growth of that industry. But what that's mean is that you've probably had 490 stocks in the S&P 500 that just haven't been worth anything, right? Haven't really helped you. The other 10 have driven all returns. But this has been the primary theme all year. And as you've seen on the chart of the right-hand side shows forward-looking price multiples, right? So this is the price to earnings ratio. This kind of measures, are stocks cheap? Are they expensive? And what you see is that darker line, which measures the FANG stocks, have really just gotten expensive this year, right? They have just expanded like crazy, whereas the rest of the market has kind of been slogging along, I think, if, for lack of a better term, right? It's just been slowly moving along. And this can be looked at in a couple of different ways. One is, yeah, it's a very, very narrow market. And I think it kind of creates some concentration risk for investors who are so heavily invested in those businesses. Second, though, I think it means that there could potentially be opportunities outside of those areas, because areas outside of, especially the major tech companies, are much more reasonably priced, right? When they're much more reasonably priced, you're much less worried about buying into equities when they're at a very reasonable historical valuation, rather than if everything had moved up. So this is something to keep on looking at as we move forward. Is something certainly we're looking at. But higher for longer rates could put pressure on equities in some ways, right? One, higher rates typically mean that the multiple, so the PE ratio or the price multiple that somebody's willing to spend per unit of earnings, right, for a company is just less. Also, now debt is more expensive for businesses. So that's something just to keep an eye on, and to understand the lending standards are, how is the debt market for companies to access capital. That's something that certainly can change quickly, but as it is today, getting funding is much more expensive today than what it was just a couple of years ago. Good part, earnings have remained strong. We'll talk about corporate fundamentals here shortly, but you'll see earnings have remained strong, margins have remained strong, balance sheets look good. So from that perspective, we don't certainly see leverage going crazy. It's just one of those things where Fed's raising rates to slow things, and the market's trying to figure out what ultimately will happen to corporate fundamentals as we move forward, and really corporate earnings, unemployment, and all those different factors. This is a colorful little chart, but I think this is what we always want to make sure we highlight with bonds. It has been not fun for bond investors for 2022 and the first 10 months of, or first 9 months of 2023. As rates have risen, bond investors have just really not benefited. They've been hit just, not as hard as equity investors, but it certainly hasn't been a normal environment as bond markets have adjusted to higher rates. Here's the good part. The best predictor, right? It doesn't always work out this way, but one of the best predictors of a forward-looking return in bonds is, what is your starting yield, right? And this graphic shows along this kind of really a very high relationship, your starting yield and the next 5-year return, right? So if you start at 5% yield on your bond portfolio, what does your next 5 years look like? And you can see a very, very strong relationship. And you can see what's happened in bond markets and interest rate markets over time. The 1980s and the 70s, rates were much higher. For investors who were around during those times, you know rates were much higher in the 70s and 80s because inflation was out of control. Much different environment. But what it made for was an environment that was very conducive to bond market returns, right? And that's where you see starting yields much higher and the returns over those next 5 years much higher. The challenge over the last really decade was that we've lived down here. It is hard to generate yields in bond markets when interest rates were so low. But as we look forward, the good part is now we are getting back to the mid 2000s level in that green shaded area where our starting yields are 5, in some areas north of 5, well north of 5. So on a forward-looking basis, our opportunity set looks much better than it did just a few years ago. So while it's been painful, and I think some investors have gotten fatigue of looking at bond markets and saying, what can we do here? The good part is that pain on a forward-looking basis certainly makes your bond portion of your portfolio look much more attractive and will, historically speaking, hopefully benefit from that adjustment period over the last 18 months or so. What's going on in corporate America? Because we get the question every once in a while. A lot of times what happens is the Fed raises rates in an attempt to fight inflation, and then just something breaks. Sometimes it's something that's predictable. Sometimes a lot of investors don't realize it, but something breaks. One thing we always look at is, what is the health of corporate America? On the left-hand side, these are profit margins, and you can see that they have actually increased pretty consistently over the course of the last several decades. While we're not at the highs that we saw in 2021, as of the second quarter of this year, profit margins on just a macro level still look really strong, right? These margins have not been squeezed. Will they get squeezed if labor costs pick up? Will they get squeezed if something changes or inflation picks up? Certainly, right? There's always a chance that nationalization of certain industries or trying to kind of reshore your supply chains and things like that can always change input costs and things of that nature. But at the most macro of levels, profit margins still look good. On the debt side, you can see the purple line is interest coverage, right? Interest coverage for major corporations remains really strong. It looks as strong as it did back in the 60s, right? That long ago, we have to go back to see an interest coverage perspective, right? The ability to cover your debt interest really strong. And you can see leverage in the blue line, while it's not at certainly its lows by any stretch of the imagination, it's not at its all-time highs. Companies clearly aren't stretching super hard from a leverage perspective, but that is something certainly, that's industry by industry, company by company. But at the most macro levels, both of those measures look pretty good. Additionally, I think the bond market does a really good job of telling us where we stand on things, right? The bond market right here tells us a couple of things. One, the blue line is default rates. You see default rates are still pretty low. They are going to pick up. That's likely to happen. They've been very, very low. Default rates will likely pick up, but that gray line is important. That gray line is really the spread that credit investors, right? Investors who are trying to get yield out of the high yield market, right? So lower credit quality bonds, what they're being compensated to take that excess risk. As risks pick up in the market, bond investors require more, right? They want to be compensated at bigger yields to get that. But what we're seeing is that bond markets aren't anticipating this really bad default heavy environment. They're very tame. So despite market slowdown, economic slowdown, at the most kind of high level, the bond market tells you things are pretty good. Corporate fundamentals look pretty good. Profit margins and earnings look pretty good, right? There's just a lot going on in the interest rate world that is creating volatility, and just certainly that will have an effect on markets. But I think investors should just understand that there's more to it than just where interest rates are or where inflation is today. So just real quickly, where do we go from here? I think our focus is now on growth, not necessarily inflation. Can economic growth hang in there? And the Fed deciding kind of where they go with interest rates will help kind of drive some of those expectations. But by and large, if we just spent a bunch of time on it, both balance sheets and inflation and unemployment, they're pretty well behaved right now. We should just look to 2024. Where does growth go? Where do earnings go? And really, when will rates get cut, right? And I think rates are going to get cut, but it's going to be slow. It shouldn't be this expectation unless something major breaks, which you never can really predict that, but we don't see anything right now that gives us major pause. We should really try to just kind of look at the data and expect, it's going to be a choppy, next 6-12 months, really kind of as it always is. Good part is the bond portion of your portfolio, it's been difficult for investors on a forward-looking basis. The good part is we are really optimistic for bond investors, and we do think bond investors are going to get compensated finally for that portion of their portfolio. It's just been a struggle really with higher rates. From our positioning perspective, not a lot has changed over the course of the last 6 months. A lot of what we've believed is starting to kind of get priced into market. So, a lot of our positioning has held true where we're overweight the US over international. We still see a strong dollar, and that we believe will help US investors investing domestically today. We do have a more defensive posture, right? We've just continued to keep a more defensive, diversified approach on the equity side. We don't see it now as a time to load up in small cap or emerging markets because those higher risk areas tend to need more catalyst. And even if they look attractively priced, we just have to be careful that we reconcile that with a slowing growth environment. But we do still like the semiconductor, like the chip industry, communication services as a sector, right? The Googles and the Metas or Facebooks, they look really attractive on a forward-looking basis. And on the bond side, we're really focused similarly, more defensive in the core space, investment grade fixed income, right? That means treasuries and high quality corporate bonds and mortgage-backed securities look really, really attractive right now. We'll have a little high yield, right? A little bit of that exposure, but today we don't see the need to reach for those higher risk fixed income pieces because you're not being compensated that much to take excess risk. So we're certainly light in that area. One area we are looking to take a little bit of I don't want to call it maybe I guess a tactical view is duration exposure, right? Adding a little to duration. Everybody wants to be short right now, right? And there's a part of the portfolio that should be short because you're being compensated pretty well to stay in money markets and short-term treasuries. But history has shown adding duration, right? Locking in those rates where they are today, yields as you go farther out in the curve on a forward-looking basis is certainly something that's really positive for portfolios on a forward-looking basis, right? It's tough to do that now. It's sometimes you don't want to extend beyond the short term, but it's somewhere that we actually do think adds value. So we're actually going to likely add a little bit of duration to portfolios as rates start to kind of plateau. So I went through a bunch.
Yes, I know we have 1 minute, and so we probably have time for one question that I have here for you, which is, what's all that chatter about digital dollars?
Ooh, digital dollars. Yeah. A lot of this, it all ties back, right? Candidly, I'm not the foremost expert in digital dollars, but what you're seeing is so much going on within just really the crypto space, within digital currency, digital wallet, right? There's different countries who are differently exposed. I think what we're going to see over the next decade clearly is a conversion to figure out and kind of bring the financial markets to 2023, right? So many parts of our world have become driven by AI, automation, driven by, and big push of crypto is to decentralize things, to make transfer of currencies, this and that. But candidly, I just think a lot of it ties back to that conversation, right? A lot of it ties back to trying to make the free flow of capital quicker, cheaper, more efficient, global, right? And so much of whether it be the digital dollar or digital currency or cryptocurrency or all those little things, it all ties back together to that main kind of now there's a lot of things that are tied together, right? Our financial system, our banking system, the way our capital flows, the way banks are capitalized, all those little things have to get figured out. And the ability to do high frequent transactions. But I think what you're going to see along with AI, and I think fintech is an area, right? Financial technology, the advancement of fintech and how it relates to all those different areas. I don't know where it's going to go. I'm very kind of, it's an exciting area, right? I think it's a lot of people get concerned, right? And there's natural regulation, there's all those questions, but that's something that, we'll see over time. I'm certainly not the most foremost expert in that space. Just an area that kind of we follow and keep an eye on to see, like, does it have relevance to our portfolios, our companies, or the way we think about the world. But we will see where that entire fintech world and the currency world goes, especially how much has changed over even the last 2 to 3 years within that space.
Right. Thank you, Mike, as always, for answering the question and for all the great information shared. We will be sending this around to all our clients. Feel free to share with others that you think could benefit, and stay tuned for our next one come early next year, which is shockingly close. Thank you, everyone. We appreciate you very much and are honored to serve you. Bye.
Thank you.